Hello everyone, welcome back to Investors Meeting Point. KEC International had a weak Q1 financial year 27 with revenue almost flat at 50.2 billion. EBITDA fell 16.9% year over year to 2.9 billion. Adjusted PAT dropped 41.7% to rupees 726 million, mainly due to Middle East disruptions, labor shortages and slower execution. The main concern is therefore near-term profitability. However, the weakness appears to be largely due to execution challenges rather than lack of orders, which keeps the longer-term outlook of the company as positive. The biggest positive is the company's 377 billion order book, equivalent to around 1.6 times trailing 12 months revenue. Q1 financial year 27 order inflows increased 14.2% year over year to about 66 billion, with T&D contributing 30%, SAE Towers 27%, civil 15%, cable 12%, railways 4%, and renewables and others 12%. Management is also targeting approximately 300 billion of order inflows during financial year 27, including around 200 billion from T&D. This provides substantial medium-term revenue visibility despite the weak first quarter. The business mix gives KEC International another positive signal. Transmission and distribution, or T&D, accounts for 52% of the order book, with strong opportunities in renewable energy, HVDC, and data center transmission projects. The cable business grew at 56.9% year over year in Q1 financial year 27 to around 6 billion, while SAE Towers grew 25.3%, supported by over 16.5 billion of international orders. These growing businesses can help diversify revenue and support future growth as weaker legacy projects is gradually recover. The analyst expects KEC International recovery to be stronger in the second half of financial year 27. EBITDA is projected to rise from 2.9 billion in Q1 to 5.9 billion in Q4, while the EBITDA margin is expected to improve from 5.8% to 7.3%. For financial year 27, revenue is estimated to grow at 12.4%, with EBITDA growth of 5.1%. More importantly, financial year 28 could see a stronger recovery, with EBITDA expected to grow 28.3% and adjusted PAT by 38.7%. This expected improvement in profitability support the positive medium-term earnings outlook of the company. Working capital is currently a key concern, but the outlook is improving. Management aims to reduce working capital days from 135 to 110 days, which could unlock a significant cash. An inventory release of 2 to 2.5 billion and recovery of around 3 billion in Afghanistan receivables should support this improvement. Net debt is also expected to decline by nearly 16% by March 2027. Most importantly, free cash flow could improve from negative 7.4 billion in financial year 26 to a positive 9 billion in financial year 27, indicating a strong recovery in cash generation. Analysts have Rs 523 target price for the stock, indicating around 16% potential upside. As earnings recover, the valuation is expected to improve, with PE declining from 16.7 times to 12.1 times. EPS is projected to grow at 10% in financial year 27, followed by a strong 39% growth in financial year 28 estimates. Thank you for listening to this video. Thank you for sparing your valuable time. Happy investing.